Welcome to CoreLogic's update on housing market conditions for July 2018, brought to you by Smartline Personal Mortgage Advisors. With data now available through to the end of June, we can provide an overview of the housing market's performance over the financial year and our views on where the market's likely to be heading from here. CoreLogic's National Housing Market Index showed a remarkable reversal in housing market conditions over the past year. A year ago, national dwelling values were up 10.2%, largely driven by surging values in Sydney, where the market was up 16%, and Melbourne, where values had tracked 13% higher over the year. The most recent financial year has seen the national index slide by 0.8%, with Sydney values down 4.5% and Melbourne values edging only 1% higher. Although most of the focus has been on slowing conditions in Sydney and Melbourne over the past year, every capital city apart from Perth has shown a weaker performance over the most recent financial year relative to 2016-17. Although there are some variances across the product types and the valuation segments. Across the broad product types, the detached housing sector has underperformed relative to the unit market, with capital city house values down 2.2% over the financial year, while unit values managed to eke out growth of 0.4%. This stronger performance from the unit sector was heavily influenced by the Sydney and Melbourne housing markets, where the unit sector has been more resilient to a downturn, likely due to the more affordable price points available within the unit market and the surge in first home buyer demand, where first home buyers are clearly more focused on more affordable housing stock. Every other capital city where housing affordability constraints are less challenging has seen the detached housing sector outperform the apartment market. We've also seen some divergence in housing market conditions across the broad valuation segments. The combined capitals index is showing clear weakness at the most expensive end of the market, with the most expensive quarter of housing recording a 3.6% fall in dwelling values over the year, while the most affordable quarter of properties have seen values actually rise by 1.4%. Once again, this headline trend is heavily influenced by Sydney and Melbourne, where the most expensive quarter of the market has seen values fall by 7.4% and 2.5% respectively over the financial year. Most other cities have seen relatively little difference in the performance of properties across the broad valuation spectrums. Another sign of diverging performance can be seen in advertised stock levels. The number of properties advertised for sale in June 2018 was 22% higher than a year ago in Sydney and 10% higher than Melbourne, while every other capital city has seen a reduction in overall advertised stock levels. A rise in inventory levels implies buyers have more choice. They have more ability to negotiate with vendors and less urgency in their decision making, which helps to alleviate any upwards pressure on prices. Demonstrating the impact of low advertised stock levels, the strongest capital city housing market, Hobart, has almost 30% fewer homes currently advertised on the marketplace compared with a year ago. The change in housing market conditions can also be seen across CoreLogic's vendor metrics, including auction clearance rates, median selling time, and vendor discounting rates. Across the combined capital cities, auction clearance rates have reduced from 67% of the end of the previous financial year to finish 2017-18 about 10 basis points lower at 55%. The two largest auction markets, Melbourne and Sydney, have seen clearance rates reduce from 71% to 60% and from 68% to 50% over the year. Median selling time has increased by 3 days over the year across the combined capital cities to reach 43 days. The Sydney housing market has recorded the largest increase, with the median selling time increasing by 20 days over the year to reach a median of 46 days on market. Conversely, homes in Hobart are typically selling 20 days quicker, averaging just 29 days based on the most recent data. Growth in Brisbane dwelling values has slowed over each of the past two financial years, with an increase of 1.1% over the past 12 months. The past year has seen the weakest financial year performance since values fell by 3.6% over the 2011-12 financial year. Although the rate of growth has slowed, Brisbane housing values have increased over each of the past 6 financial years. In a sign that the Brisbane unit market may be emerging from a period of sustained weakness, unit values are up by 1.7% over the June quarter, while house values rose by only 0.1% over the past 3 months. If this is the start of a recovery trend, the local unit market needs to see values rise by a further 11% before recovering to their 2008 high. The weakening in housing market conditions should come as no surprise, considering the changed regulatory environment, which has limited the availability of housing credit, especially for investors. Annual housing credit growth has slowed from 6.6% over the previous financial year to 5.8% over the 12 months ending May 2018. The slowdown in credit has been entirely driven by less lending for investment housing, where the annual rate of growth has fallen from 5.1% a year ago to 2%, which is an historic low. Lending to owner-occupiers has held reasonably firm, in fact, showing a subtle rise from 7.5% a year ago to 7.9% over the 12 months ending May 2018. The improvement in owner-occupier finance has been driven by a surge in first home buyer lending, mostly emanating out of New South Wales and Victoria, where stamp duty concessions have supported renewed demand from this sector of the market. With APRA lifting the 10% cap on investment lending this month, there's been some speculation that this could see a rebound in investment lending. However, we believe this is unlikely. The 10% speed limit has become largely redundant, with broader limits on interest-only lending, more focus on debt-to-income ratios, and greater scrutiny of borrower expenses and incomes likely to continue to muffle investment-related credit growth. Additionally, investors continue to pay on average a 60 basis point premium on their mortgage rates. While higher mortgage rates and more stringent lending criteria are having a clear effect on investor participation in the housing market, other barriers are also apparent. Despite the slippage in home values across Sydney and to a lesser extent Melbourne, dwelling values remain very high relative to other capital cities in these markets. With lenders now scrutinising borrowers with a debt-to-income ratio of more than 6 times, housing markets where prices are high relative to incomes could see less activity as prospective buyers find their borrowing capacity reduced. This is certainly the case in Sydney and Melbourne, where the dwelling price to income ratio is 9.3 and 8.0 respectively, while the remaining capital cities have recorded ratios below 6.5. Additionally, with the federal election campaign imminent, we could see investor confidence impacted further if changes to taxation policies related to investment housing are debated. Rental yields are improving from a low base. However, it's likely that the majority of property investors are offsetting their cash flow losses against their taxable incomes. Changes to negative gearing would likely add a further material disincentive to investors. Although the market expects official interest rates will remain on hold until at least 2020, there is growing pressure on lenders to lift mortgage rates due to higher funding costs being experienced overseas. Smaller banks and non-banks have more exposure to international funding markets, which has seen some of these smaller lenders start to adjust their mortgage rates higher. Considering households have become very sensitive to changes in interest rates due to record high indebtedness, higher interest rates along with tight credit conditions could place some additional downwards pressure on housing markets. A weaker housing sector would likely show a flow-on effect to economic conditions, creating some drag on consumer spending as the wealth effect reverses and dwelling construction winds down, as well as creating challenges for those industries that are at least partially reliant on housing turnover. Overall, we're expecting housing market conditions are likely to remain relatively soft over the second half of 2018. Of course, there will be substantial variations in the performance of the sector, so make sure you're staying up to date with all the latest trends at the CoreLogic website at www.corelogic.com.au.